eClerx had a relatively muted quarter, but marginally exceeded expectations, and an exceptional item aided the company's profit growth to as much as 11.5%. Joining us to discuss this quarter gone by is Rohitash Gupta, the CFO at eClerx. Hi, Rohitash. Thanks for joining us. My first question will have to do with the expectations of the second quarter being weaker owing to a roll-off in one of your clients, but it's turned out to be a much better quarter. Can you take us through your revenue growth and the factors that you attribute to your revenues for this particular quarter?
So you are right that this quarter was slightly better than what we were expecting because one of the large clients which we have anticipated to roll off in Q1 indeed rolled off, and that created a loss of a lot of revenue. Despite that, we were able to achieve a decline of less than 1% quarter on quarter against the anticipation of 2 to 4% decline. So in that context, it's a slightly better output. On the margin fronts, however, I would say that margins further came down, and the excess of people that was created because of this large roll-off at the end of Q1 could not be fully redeployed, and our attritions also came down, which otherwise is a good sign, but that clubbed with the roll-off and excess people created a margin pressure this quarter. We think that both the revenue as well as operating margin situation will improve from Q2 levels onwards. In terms of highlights of the quarter, I would say two or three things. The first is that we have been growing in the right areas because the new sales that are added in this quarter or even in H1 were in the areas that we are strategically focused on. Number one, analytics. Number two, digital. Number three, onshore and consulting. So all these areas have shown tremendous growth in this H1 compared to last H1. And we anticipate that share of these services which we hope are much more sticky and less amenable to future roll-off risks, either due to automation or due to other threats, is relatively lesser. So I think the risk portfolio is definitely, risk of the portfolio is definitely getting better.
Okay, Rohitash, so there has been a ramp up of on-site and managed services business and deployment. Of course, there is an expectation on the street that could lead to some amount of weakness in margins. Can you take us through some of those factors as well?
Yeah, two or three facts around that. So the reason why we are wanting to grow in certain specified segments, be it onshore, be it consulting, be it tech services or analytics, is because we feel that these are at less risk compared to offshore FTE business. And we have seen the negative manifestations of that business in the last three client events also. So we feel that these new growth areas are sticky. However, in the margin terms, as you rightly said, some of these services are definitely lower percentage margin compared to offshore FTE business. And that's the nature of the beast. And what the hope is that some of these services also entail downstream BPO services, which will make up for the margin, at least in the margin pool sense, if not in the percentage sense. So we think that there will be tail end effect to this, our current strategy, where we will get closer to the customers and eventually will get even offshore BPO business also by virtue of it, which is more profitable.
And will the deployment of robotics across client segments also have a negative impact on margins, at least in the near term?
You're absolutely right. And in fact, I won't say near term. I would say that some of that impact is already baked in the numbers that you have seen in the last few quarters. And some more effect may come as the time goes by. So what happens with robotics is that you have to give the productivity benefits back to client, and robotics is a new technique of doing or achieving the same requirement. And it does create margin pressure because you lose your profitable people-driven business and deploy technology, which typically is more efficient in terms of cost to client and hence less profit.
And finally, Rohitash, from what we understand is that more than half of your deal pipeline involves digital deals. Can you tell us a little more about the deal pipeline as well?
I will make a slight correction. The deal pipeline as it stands at the end of Q2 is double than the corresponding number 12 months back. That's point number one. Point number two is that the current pipeline, which is roughly has a visibility of 3 to 6 months in future, almost close to half of it is actually from financial markets. And the remaining quarter and quarter, I would say, is from other two verticals, digital and customer operations.
All right, Rohitash, thanks for joining us and taking us through those quarterly numbers, as well as the outlook, of course.